Okay, let's begin. Hello, guys. Welcome to the Academic Observer for Economics, Business, and Finance. It's quite early in the morning, actually. I don't know if you can see by my eyes. It's 6:45. And before I go on a little jog, I had this episode topic in mind yesterday evening, so I didn't want to forget about it, so I'm just going to record right now. This episode is about a topic that I haven't talked about too much, I don't think, in other previous episodes, and it has to do with bonds. It has to do with the bond yields. And to make it more interesting, because then it's super boring, it also has to do with this one apparent country that seems to be wanting to control monetary policy tightening for everyone around the world. And I'll try to defend my point. I hope it goes through very nicely and you'll realize what I mean by the end of the episode. Now, to keep you guys guessing on your toes a bit, the mystery country, I will not just tell you right now, but it's not the United States with the Fed. It's not the Bank of England. It's actually not any country within the European Union as well. Not even the European Central Bank, actually. Bear that in mind. Now, let's begin with an observation. Look, last year, 2023, you might have noticed that bond yields experienced a significant upward trend. Bit of an anomaly there. Looking at the 10-year to-day chart of US Treasuries, for example. The risk-free rate, the most important price in the world. And during this rise, it is normally accepted that the 10-year Treasury notes face some sort of cyclicalities, right? And in the first half of the year, 2023, the Treasury interest rates would go just above the 4% level at their peak, almost an arbitrary level, and then the rates would simply bounce back down in a normal reverse trend. And I believe this cycle happened like twice. But at the third time coming, something interesting happened. The buyers, when they reached that 4% level, they didn't come in to reverse the market anymore. So instead, you had the US Treasury 10-year yields breaking out to north of 5% in quite a continuous way as well. And this breakout brought about a lot of discussions to the board, asking, what happened here? One narrative said it had to do with the Fitch ratings downgrading the US's investment performance. To that first narrative, I thought to myself, look, there are other more relevant or equally relevant graders out there like Moody's, like the S&P Global, and they've kept their silence during the same period, so I wasn't sure if it was that impactful. Then I looked at the second narrative, and the second narrative had to do with the U.S. Treasury issuance. That's the thing. So the supply of U.S. Treasuries, it was simply greater than what people expected. And again, my question to that is, who are these people expecting what? There's a lot of who, what, when, why is going there, and that's a gray zone for me trying to learn anything in life. I don't go through those. If I don't understand it, I don't understand. For me, it's a bit ambiguous. So, the third narrative, which is the one I want to touch into for this episode, has everything to do with the central bank of Japan. Yes, for some reason, people kind of ignore as well this third narrative, but I won't because it makes the most sense to me, okay? The other two narratives, they don't match what I believe to be logical market price action behaviors. How does an announcement of a Fitch rating or an issuance talk make yields behave in the positively continuous linear trend that we witnessed last year? I think they would have caused something a bit more reactionary than what ended up being. So that's why I'm siding with the third narrative. Now, hold up, no. What's up with Japan? Why are you blaming Japan for this? What's up with the BOJ? For those familiarized with monetary policy in general, like general knowledge of monetary policy, you would know that when the BOJ, Bank of Japan, changes their yield curve controls, for example, for their JGBYs, the Japanese government bonds, it causes great global market shakeups with them. And why is that? Well, the Japanese are what you'd call global duration anchors. I mean, they're the largest foreign fixed income investors in the world. Interesting fact. They deploy by the buckets, trillions and trillions of dollars overseas. So much so, almost guaranteed to you, they will be dwindled, in in your own government sovereign bond market, wherever you may be around the world. They're the largest foreign holders of US Treasuries. They are the largest foreign holders of French bonds. They are the largest foreign holders of Australian bonds, and I'm sure of other sovereigns too. So what I want to say here is that what happens with monetary policy actions domestically in Japan also matters for the world and for international fixed incomes as well. Given this, look at what happened then. Firstly, the BOJ decided, let me check here, around June of 2023 it seems, they decided to lift their yield curve band to control cap on yields from what was at the time 50 basis points, a half a percentage point, to a full percentage point, to 100 basis points. And this announcement is made. Look at what happens to the 10-year yield. You see there's an upward trend. You see the same thing I'm seeing. I mean, the JGB yield just keeps lumping upwards. They blew from the 50 handle to the 60 basis points in just a matter of days. And then you ask yourself, look, what happened to the US Treasury yields, which on paper should have nothing to do with this because we're looking at the 10-year yields for Japan, not the US. What happened to the US Treasury yields for the 10 years? Look, it jumped subsequently as well. Look at the 3-month rise between the US and Japanese bond yields. They're basically locked in after the announcement is made. So it seems to be, you can say, look, it's not perfectly correlated, but come on. It's almost perfectly positively correlated between the two. So sure, trigger catalysts like Fitch ratings or issuance talks of US Treasuries, yes, they can be relevant to this rise in the 10-year yields. Sure, because they can cause people to sell. I don't know what's the behavioral consequence of these announcements, but let's be honest, the BOJ moving that cap from 50 basis points where yields had been pressed against all the way to 100, which is double the amount. That is the only direct market trigger catalyst that I see, in my opinion. Of course, I should say a disclaimer here. There should never be a single reason for any market move, any change in risk-free rate, let alone for the US Treasuries. Come on, let's be honest. But I would argue that the proportion of attention given to the BOJ, given its characteristics worldwide, would have propensed it to be or play a significant part in this. That is my take. And so here's the next observation I make. Japan, through this, seems to want to inject uncertainty to the markets. And this hike in yields helps their cause. Why? Look, not why. Other countries, they're just looking at this and they're kind of walking in eggshells now in speculation. They're out there thinking, okay, when is Japan stepping in again? What are their notional amounts? What are their unscheduled bond buying operations? All of this now starts to matter to them after this swift hike, okay? And it helps the Japanese because we know they've been struggling with inverted yields and negative yields. It's been the strangest things. So it's important to them to get more grip on this. They can control inflation better, kind of start normalizing their policies a bit more because the Japanese have been on an ultra loose scale of monetary policy in the last couple of years. I'm sure you know of the negative interest, the heavy asset purchases going on in that country. So yes, it can play to their advantage greatly, but we have to also understand that it changes the rest of the world with them. To make matters even more confusing to yourself as a listener and to investors in general, you then had the Bank of Japan meeting in October. So the hike was made in June. In October of 2023, they added even more uncertainty. How so? Well, instead of having the explicit cap of 100 basis points where the 10-year yields for JGBs can trade up to, that cap is no longer there. They just dissolved the 100 basis point barrier and named it a reference rate, whatever the hell that is. And people were expecting them instead to rise from 100 basis points to 150, which is normal. In January 2023, they hiked it from 25 to 50. In June, from 50 to 100. You would expect now in October from 100 to 150. But no, disappeared. No more upper limit. For the first time in post-QE history, the world is finally now without an explicit central bank put option. That is crazy. It's quite historic as well. We basically don't know when or if the next level of tolerance will be for Japan. And it's even crazier to record that in 2022, as recently as 2022, 2 years ago only, Japan would not even budge it was 25 basis points at the time of their 10-year yield cap. They wouldn't change. Come hell, come high waters, it's staying the same. The 10-year yields were at 1.5%, I believe, and it went up to the 4 handle. You had the global central banks ripping rates by 100 basis points, but Japan stood firm at that 25 basis point cap, right? And eventually they gave way to a rise in the upper limit to 50 basis points, as we said in January of 2023, to improve bond market functionalities. That was their excuse at the time, because they started to realize a little trend. Every time they promote a new cap on the 10-year yields, there will be an almost immediately response of concentrated buying at the 10-year tenor, that you get this very kinky, messed up looking yield curve, where the 8 to 9 year JGB yields are yielding higher than the 10-year yields and higher even than the 10-year yield caps as well. So, and they witnessed the same response when they raised the cap, not just from 25 to 50, from 50 to 100 in June. There was another humongous selling spree. It was a massive backfire for them. The kink for the yield actually worsened. These market participants, especially in the forward community, they just deployed. Okay, they went on a huge selling spree. Okay, so kind of forcefully, the Bank of Japan, the Japanese have to bluff and defend every time they set a new upper limit. Okay, they can't capitulate. I mean, they can't capitulate or move the cap higher so soon after the latest hikes. So they fight this new momentum to the point where once, actually in January, when the first hike happened from 25 to 50, right? They bought around $180 billion notional worth of JGBs in a single month. In 1 month, January 2023, when they had just announced, again, that new 50 base cap. Let me put that in perspective for you, the listener. During the peak of quantitative easing by the Federal Reserve in the United States, the US was dealing with 120 billion, around that amount, dollars worth of buys in a single month. In that period of January, the Japanese dealt with 180 billion. That is 60 billion surplus, more than the US ever did worth of QE in a single month. And this was during a period of monetary tightening around the world. Just so you understand the level that Japan plays at. So that's why they decided to get, once and for all, more ambiguous with it. Enough. Every time we hike, we have to buy. Let's just destroy. We just keep that 1% there for good measure. But now there's no explicit cap on their 10-year yields. What happens next? Frankly, it's confusing, and it's purposed to be this way to disorient market participants. That's their objective. I've heard officials from the very, very higher ups as well saying, look, it was impossible for Japan to remove the band-aid of a yield curve. That will never happen. And now they're shell-shocked when it happens, actually. Look, I'll give an analogy here. It's like us as investors. We're about to take a penalty, right? But we don't know, by the time we shoot the football towards goal, we don't know where the goalposts are. Now, the truth is, though, you could be shooting to the stands for all that you care. So it's not very reassuring for you as a penalty taker. The truth is, though, since this new measure took place, the BOJ has actually been scaling down their asset purchases. So it's beneficial for them. It's going as intended, in a way. The month of January 2024, last month, they only bought $40 billion only worth of JGBs through open market operations. It seems like a lot, but it's compared to January of last year, which was 180 billion. Actually, this January, it was the lowest level of bond purchases made by the Japanese in a single month for the last 2 years. So it's good news for them. You as the listener now, you could ask me a very interesting question then. Look, will Japanese bonds therefore follow like a similar trend to the leading US Treasury now that they don't have a fixed upper limit? Look, the point of the BOJ is for you not to know this answer. It's not for you to know more. So it's hard to respond. I did observe that the FOMC from the United States, they're now buying JGBs at a fixed rate to sort of mask all this ambiguity, and yields have backed off since. Of course, there are many other probably relevant factors involved, so research more about this. Here's where I want to get for this episode. That's the purpose so far. Okay? This is what you've been waiting for. Look, if my third narrative, that the BOJ is the culprit for the rise in US 10-year Treasury yields, is true and not the other two narratives and any other narrative that might be out there. And then you have a Jerome Powell, the chairman of the Fed, out here freely saying, look, an increase in long dates Treasury yields is doing the monetary tightening for us in the US. Well then, technically, the Bank of Japan is doing the tightening for the Fed, right? Connect the dots. So is global monetary tightening policy now being run from Tokyo? That's my question. Is their influence that big? And that was my curiosity yesterday evening. This is what I wanted to get to. Get you guys thinking as well. Thank you for listening. This is Noon Gomes for the Academic Observer on Economics, Business, and Finance. And it's time to go. Bye-bye.